Hello and welcome to this week's GoNoGo show here on StockCharts TV. My name is Tyler Wood. I am a CMT charter holder, and today, as always, I am joined by the chart master, Alex Cole. How's it going, buddy?
Good. We got some sunshine coming through the window.
I
Feeling
can
good.
see that. Either that or you're on your way to a better place. I can't tell. Alex, as we do each week, let's start from the top level, looking across the asset classes, give ourselves a little context for the environment in which we are investing and trading. I'm seeing some rotation. Talk to us
Yeah.
about what's on this map.
Yeah. I mean, we've been looking at this now for a couple of weeks, but we've got strong trends in equities. You can see that we had that couple of periods of weakness, and then we've really made up our mind, and we've entered strong go bars again. What a week, really, this week we've seen so far. Treasury bond prices remain in a go trend. They've seen some strength as well over the last couple of days. And then we can see now that we were talking about the chop in commodities. Well, we seem to have made up our mind there. No go now for a couple of weeks. Painting a weaker pink bar today, but definitely in a no go. And then, of course, the dollar. We'll look at that chart later, but the dollar remaining in a strong no go.
Absolutely. Let's turn our eye to the equity markets and take a look at the S&P 500 on both a daily and a weekly time frame. We talk ad nauseum about the importance of multiple time frame analysis here at GoNoGo Charts. From a trend perspective, on this daily chart of the S&P 500, I'm seeing overbought momentum in the lower panel. The GoNoGo oscillator at an extreme 6 overbought reading with heavy relative volume as we're breaking out above 4,700. What do you see in terms of top upside resistance on this chart here, Alex?
Well, what's interesting is this is that period where we saw on that rel map, that asset class map, there was a little bit of weakness in here as price moves sideways.
Mm-hmm.
What's interesting on this daily chart is that we clearly found support. Momentum came surging back in the direction of the trend. We saw that go trend continuation icon, and that told us that we were safe for now in this trend, that momentum was staying on the side of the go trend. And then, of course, we had a couple of days where we've really pushed things higher. So this daily chart, we're not seeing too much in terms of overhead resistance. But if we back this out now to the weekly chart, we're going to see that we are looking right at these all-time highs. And here we are. We're now closing above those levels. So we said it last week, don't let the top of the chart fool you into thinking it's resistance. So we are now sort of clear above, really.
Mm-hmm. And what's important, I think, for a lot of investors in this marketplace, we've seen some strong Friday rallies. Everybody has kept an eye on the Fed. Chairman Powell giving his announcements this week about maintaining these higher rates for now, maybe against some of Wall Street's expectations. But the market kind of pricing in a soft landing, that the Fed has somehow managed to thread the needle, avoiding major economic recession and perhaps looking at up to 3 rate cuts next year. But you know what? Let's not talk about the speculative narrative trying to predict what Chairman Powell and others are going to do. Let's take a look at the TNX, the 10-year US Treasury yield, and just get a sense of what's happening in the interest rate environment after yesterday's announcements.
Yeah, absolutely. So let me just adjust this chart really quickly. I had a bit of a fat finger and typed in the wrong ticker, but here we are. We're now looking at the weekly chart of Treasury bond rates. Mm-hmm. And you can see that we've got trend change. We had the oscillator riding the zero line, telling us it was a little bit of a tug of war, and then we've rolled into negative territory. So that tells us that now we have negative momentum, which of course doesn't make sense for this go trend. And so now GoNoGo trend has painted an amber go fish bar. And you can see we are entering into this range that we were in for quite a long time. We thought we'd broken above it. We haven't found support at the top of that range, and we're now in the middle of that range. And if I move it down to a daily chart, you'll see how much more destructive that looks. On a daily chart, we can see that this no-go has been in place now for quite some time. Very similar picture in that we had new highs in price, and then the oscillator testing the zero line, failing to find support, even though the go trend wasn't quite over. And then, of course, no-go ensued. We've seen now several moves lower. We're seeing a lower low now this week as the oscillator continues to be rejected by the zero line and stay in negative territory. So on this time frame, strong no-go in place, negative momentum, and that's bleeding into the weekly chart as you saw.
And that's why we saw on that earlier heat map, Treasury bond buying, right? The price moves of TLT, long-term Treasury rate ETF, back in Go trend conditions. Investors buying up some bonds as these rates roll over. Now, Alex, we know that correlations can change over time. The last several years, this move in U.S. Treasury rates has certainly been a headwind for risk assets and equities specifically, as we saw things spiking higher and kind of runaway rising rates as the Fed attempted to stem the tide of inflation. Now we're seeing this, potential mean reversion. I like that weekly chart, which signals that we're not trying to predict that rates are heading back to zero. Perhaps they just stabilize here for some time. But getting us back into that range on the weekly basis and seeing some stabilization in U.S. Treasury rates can certainly be a boon for risk assets and equity specifically. Let's turn our eye to the U.S. dollar index proxy. We use the ETF UUP just so we can get a sense of volume as well on dollar trading. That has also been strongly anti-correlated when we saw strength in the U.S. dollar during that seasonally weak period in October and November. We saw equity markets rolling over as that strength in the U.S. dollar kept pushing us higher. Here on the daily basis, looks like we've fully rolled over, and this week in particular, yesterday and today, dropping precipitously as the GoNoGo oscillator broke through that zero line to the downside. We talk a lot about seductive relief rallies and trying to stay out of relief rallies in no-go trends. Here at the U.S. dollar, we came right back up to test that level that had been support, turning into resistance in that concept of polarity, being rejected lower. And now we see that trend continuation icon above price as the momentum oscillator surges back into negative territory. Alex, would you mind popping this out to a weekly chart as well, just so we can get a little more context on where we're coming from in the U.S. dollar?
Yeah, absolutely. So on using UUP, of course, is a little different from the dollar itself. We can put up a chart of a different ticker too to get a sense of that. But you can see that even with the ETF, the UUP, we're at a very important moment. We've got the oscillator testing the zero level, and we've got a big move lower here in price, bringing us right back down to these levels that potentially could be support. We're going to see if that zero line holds for the ETF UUP or if it moves back into negative territory.
Absolutely. Let's do something a little different on today's show. As investors are thinking about their allocations to 2024 and considering what factors may be leading, we've seen the picture change a little bit across those what are typically Morningstar's 9 style boxes across the cap levels and value versus growth, or a blend of the above. If we look at those 9 style boxes, we could see that indeed it had been just growth, in particular large cap growth, that were in strong go trends. Now we're seeing blue across the map. Talk to us a little bit about that change in style.
Yeah, I mean, we talk about a lot. Well, with lots of our colleagues, the discussion has been about whether or not the rally in equities has been broad enough. And I think you can look at that in a number of different ways. You can look at it just by market cap, or you could look at styles as well. And I think that that's the point of this chart here, that we've now got almost all of these Morningstar styles in relative go trends to the S&P. So that means growth, value, but large cap, small cap, blends between growth and value. Mm-hmm. And you can see that across the board here, just that top panel painting an amber bar, but we're seeing these relatively outperforming the S&P. Really, that's a broader sense of a broader rally, perhaps, when you see something like this.
Absolutely. The opponents, the bears, always pointing to a lack of breadth in this rally in 2023 for the U.S. equities. Certainly seems like things were lining up for an everything rally, meaning a lot of rotation under the hood, a lot of new participants, new leadership groups. One other way to look at this would just be to take a look at a different equity index, like the Russell 2000. We can use the ticker IWM just to take a look at what those smaller cap names are looking like in terms of their trend and that new re-entry into go conditions Alex, talk to us a little bit about what you're seeing here on the daily chart.
Yeah, and I think it's sort of almost a sense of relief. It's almost as if, okay, I mean, obviously this is conjecture in my opinion from looking at the charts, but the charts seem to be relieved, and if that makes any sense to anybody watching, that there's this sense of, okay, now we can all jump in and all participate, and that's what we saw here with the small cap stocks moving back into a go trend, and then really just jumping, like almost saying, okay, let's catch up. And you saw that go trend continuation icon here, and then you've seen these gaps higher here, and you see the real sort of participation now with the smaller Russell 2000.
And important to get above those July and August resistance levels here on the daily chart. Earlier this week on a podcast for Interactive Brokers, we talked a lot about the difference in appearance from a chart of the S&P 500 or looking at large caps versus an equal weighted version like the value line geometric. Alex, pop this out to a weekly basis.
Yep.
And let's just take a look at all of 2023. Not the same kind of bull market rally in your average stock and certainly amongst those small caps. But here we are right at those areas of resistance for the Russell 2000. A breakout here and rotation into small cap names could be incredibly bullish for the economy and for markets generally. So certainly we're going to talk a little bit more about some small cap names here at the end of today's show. But the Russell 2000 looking like we'll see where the week ends up here. But a weekly close above those prior resistance levels would certainly be a very bullish sign for that everything rally. Absolutely. All right. Well, let's get back to the S&P 500. As we do in the weekly GoNoGo show, we like to take a look at the sectors against their performance of the benchmark. So we're looking at each of the 11 sector spider ETFs relative to the benchmark S&P 500. And here again, we're seeing expansion of those aqua and blue go trends. Again, we're not talking about absolute performance. We're talking about relative performance. So the index is rising, and these are the sectors that are outperforming the index, leading it higher, and seeing greater distribution across the sector groups. Certainly, we still see leadership from the XLK, the information technology sector, as well as consumer discretionary. A lot of our peer group looking at discretionary versus staples as a risk-on proxy. Real outperformance there from consumer discretionary. But as you get down that map, we're seeing a lot of the cyclical sectors also beginning to outperform. Financials, industrials, even a little peek of the materials sector into relative outperformance on weak go bars. And then, of course, real estate. And as we spoke about last week, home builders, ending the week at all-time highs, certainly a bullish sign for investors. So, Alex, why don't we take a look at the industrials group on an absolute basis? The XLI is the ETF ticker symbol. But if we go back to just a plain go-no-go chart, let's see where we're coming from and perhaps how far we have to go in this move.
Yeah, I mean, this is the daily chart, and you may well think we're overextended here, and that would obviously be a sensible thing to think. But remember, in a strong trend, we can blow past these counter trend correction arrows, right? So when we get overbought, we may come back a little bit, but we quickly rally again. So that some people buy into that kind of strength, and really we're seeing that again now at new highs. Very overbought on the oscillator. We're at a max value of 6, and we're showing some heavy volume as well. So we're going to look to see now if we can sustain these levels. There's a little bit of a gap here, which could provide some support. So we'd like to see prices consolidate at these levels, and then, of course, we'll see some cooling of momentum before potentially another leg higher. And I can throw this out.
Alex, just before you switch that over, I like to go back to the history books time and time again. There was a paper written for the Journal of Technical Analysis of the CMT Association in the 1980s by the great Kenneth Tower. Ken Tower is a fellow CMT charter holder and past board president. The title of the paper was "Overbought Can Be Bullish."
Yeah,
and I think that that message that you just laid on our viewers, the idea that momentum coming to an overbought extreme, when something is in a strong trend, that is a very bullish signal. So keep in mind, if part of your trading rules are that you're trying to fade those rallies and looking for overbought signals as a potential for mean reversion, just keep in mind, getting in front of a freight train like this could be really challenging. And
Yeah, I think just to add to that, Tyler, I think it's always very easy to see price eclipse previous levels that were considered overbought, right? So whenever there's a trend that's strong, you can look for a overbought signal as soon as we eclipse that as a signal to buy into a trend as well. Some people just buy those signals of overbought, but of course you may end up seeing, as we do sometimes, that there is a little bit of consolidation at those levels, but very rarely do we turn around after the first overbought sign, right? I mean, just in every move we see in price, there's multiple signals of overbought. Same here in the NoGo, oversold here. But you rarely turn around after one signal of an extreme like that, because if you think about it in real terms that might make sense, what you're really seeing when you see an overbought signal is you're seeing enthusiasm. And so if you're in a enthusiastic phase of a trend, it's very unlikely that that will be the end, until, of course, it's the last one.
Right? If anybody knows exactly which one is always going to be the last one, you give us a call. All right. Excellent. You were about to jump this to a weekly basis as well, just to give a little more context to this week's move.
Yeah, just to show that we are, we're on the industrials. We were at all-time highs in the summer, which we weren't on the rest of the index, and now we've eclipsed those as well. As if we close anywhere around where we are, we'll be making a new high here.
And it's ostensibly a 3-year consolidation before resuming that post-COVID rally off of the 2020 lows. So what's Luis Yamada's saying? The bigger the base, the higher in space. Right. Not that this is a basing pattern, but certainly a measured move if you were thinking about this as a consolidation within an otherwise structural uptrend. That's a big move.
Yep.
Absolutely. All right, Alex, as we do, let's take a look at the industry groups within the industrial sector and their relative performance against this benchmark. And we can see that within industrials, there are lots of industry groups, lots of segments of the industrial sector that are leading the sector group that is now outperforming the benchmark. We like to do this exercise from the top down, and we do this in each of the sectors each week in GoNoGo research to make sure that we are fishing where the fish are. From a tactical asset allocation standpoint, you're going to be looking at these industry groups as your leadership, the things to overweight, those that are underperforming, the sectors that are underperforming the index. Obviously, a great place if you trade to the short side to find some of those opportunities for really weak areas of the market. But just to take a look at what feels like an overwhelming heat map here in November and now December, we're seeing a lot of emerging Go trends, relative outperformance to the industrial sector that is now outperforming the S&P 500. Yeah. And so let's simplify the view on screen for our audience. Let's take a look at just a single ETF, the small caps within the industrial sector. PSCI is the ticker symbol. And we saw this ending out last week at all-time highs, continuing this week, gapping higher and climbing on this rally. Talk to us a little bit about this chart here, Alex.
Yeah, I was just throwing a trend line on there because it was jumping off the screen at me. Sorry about that. I like to do when it hits me like that, you got to put it on there, and you can just see how clearly that trend line was broken on the change to the Go trend. You even got given that one little Go before that big gap, which was fantastic. And then since then, we've been finding support at the zero line, but you can really see how we've raced off here. So this just goes back to the point we were making before. A broader rally. We're seeing industrials outperform, and we're seeing small cap industrials outperform. We're seeing some more strength across those style boxes. Like you said, perhaps we really are starting to look at more of an everything rally.
Certainly, as we're positioned into the year end, taking advantage of these rallies is really important. And here with GoNoGo charts, we're going to keep an eye on those top level cross asset macro factors that are going to affect our equity allocations. We're going to be with you every week, Thursday afternoons. We like to take a look at the markets. If you have any questions, feel free to shoot us an email, info@gonogocharts.com. You can head over to our website for a lot more explanation around these tools and indicators. as well as taking a look at our weekly and daily research. From Alex and I, we wish you all a wonderful week. Take care of each other, trade them well, and we'll see you back here next Thursday.